A money market is a component of financial market where a short-term borrowing can be issued. These markets includes assets that deals with short-term borrowing, lending, buying, and selling. A capital market is a component of financial market that allows long-term trading of debt and equity-backed securities. Long-term borrowing or lending is done by investors or corporations that have large amounts of wealth at their disposal. On the other hand, money market instruments consist of treasury bills, federal agency notes, certificates of deposits, commercial papers, bankers, acceptances, repurchase agreements, among others. Money market instruments are financial instruments which are issued with a maturity of 1 year or less. They provide market for investors to earn a return on liquid assets. Borrowers who need short-term liquidity have access to these funds, and they provide the Fed with a means to effect monetary policy. The money market includes the following: unsecured loans between banks, repurchase agreements, commercial paper, large denomination, negotiable certificates of deposits, bankers' acceptance, funding agreements, and money market funds. The money market is the arena in which financial institutions make available to a broad range of borrowers the opportunity to buy and sell various forms of short-term securities. There is no physical money market. Instead, it is an informal network of banks and traders linked by telephones, fax machines, and computers. The capital market plays a major role in the growth of the economy. It allows transfer of funds from people who have surplus money or seek higher returns for an instrument in companies. There are two types of instruments that are traded in the capital market. They are as follows. 1. Bonds are basic debt securities that are traded in the capital market. Companies issue bonds to raise capital as investors subscribe to them. Issuing bonds helps the company raise capital for the growth and expansion of the business at cheaper rates than banks and lending institutions. The bond issuer pays interest and returns the principal at the end of the duration. The government also issues bonds to raise money for government projects. 2. Stocks. Stocks are the rights of ownership in a company. The buyer of the shares is known as the shareholder. Investors buy and sell shares over a stock exchange. Thank you.